Thank you, Mr. Chairman. Secretary Geithner, this morning I haven't heard a whole lot with regards to federal home loan banks, and it's in your testimony and it's in the report. Can you elaborate just a little bit on where you feel their role would be? I know there's been a few problems, but generally not a lot of problems with them, and where you think that we could go with that.
Well, there's a few examples we pointed out to in the current system we think deserve attention and reform. I'll mention those again, although they're in the paper. These entities were allowed, like Fannie and Freddie were, to accumulate an investment portfolio, which we don't think is necessary, and they took on a lot of risk in that context and didn't have cap. Some of them took on some risk and didn't have capital to back that. That's something we should avoid in the future. We've also created a system where we allow large banks to be members of multiple home loan banks, and that's something we've got to take a look at again to make sure the system doesn't have too much risk. There are other things people have suggested, and we'll look at every credible idea. And I think although you're right to say that the problems there were not nearly as bad as we saw both in the private market and in Fannie and Freddie, there's some things we've got to take a careful look at.
During the course of your putting together the report, did you look at other countries and other programs around the world and what the good points of those may have been, what worked in other places, and see if they were appropriate for us? Or could you elaborate just a little bit on that?
We did. We did a very careful look, actually, and it's a very good question because if you look at the experience of other countries, a lot of countries did a lot better than we did in this crisis. But I think the biggest difference you can point to is in most of those systems, banks are the overwhelmingly dominant source of credit. And there is not a nearly as large a role for the securities markets. It's true for corporate debt. It's also true for mortgage finance and consumer finance. In our system, we have a better balance between credit provided by banks and credits provided by the broader markets, broader investor community, both in terms of asset-backed securities like real estate, like mortgages, but also just direct corporate credit. And we want to try to preserve that kind of balance. We think the system will be more stable in the future if you have that kind of balance. Now, in those systems in housing finance, as I said earlier several times, in countries where the government does not provide the kind of guarantee that we did through Fannie and Freddie, banks hold really the overwhelming bulk of risk, but those governments generally guarantee their banks. They don't let their banks fail in a crisis. In that context, as you saw in the crisis, the taxpayer is still exposed to loss, and it's just that the guarantee isn't explicit. The taxpayer isn't protected in that way. So I wouldn't look to that model as particularly appealing example of a more private system. As you know, in many of those countries, the banks are much more close to the government. The governments don't let them fail. They don't allow failure. And so in a sense, you are still socializing losses and risk in that context too.
Okay. One of the comments you made a while ago was it's an obligation of the government to protect the economy. Can you tell me at what level do you believe that is where we need to go with that?
You know, excellent question, and of course that's something people will disagree on in the moment. And again, the basic paradox of this challenge is if you build in protection against the extreme crisis, you might make the crisis more likely in the future. That's why governments get these things wrong over time. It's very hard to get that right. But again, if you look at what happened in this crisis and what helped get us out of it, you have to have the ability in extremis to reduce the risk of collateral damage that can push the economy off into in a kind of deep recession we saw. That's very important to have that capacity, and I think we can do it in a way that doesn't, again, magnify moral hazard or magnify the risk in the future taxpayers exposed. Hard to do, though.
Well, what you're saying, though, at some point, the government's going to be the backstop.
But it should be in a much more limited way, and I think we can do it in a way where it's much, much more limited, much less risk of loss to the taxpayer. And again, and not to make it overly simple, but if you require banks to hold more capital against risk,
right.
If you require homeowners to, in general, hold more equity in their homes, if you make sure that underwriting standards are more conservative in that broad context, then you will do a lot of good in making sure the system is more stable even in a deep recession. That probably won't be enough, but that'll take you a long way to it. You still may need the flexibility in emergency to come in and provide a little more protection.
Okay, with that, I'll yield back my time. Thank you, Mr. Chairman.
Thank you. Let me